Hi, in today's video, I'm going to talk about one of my favorite topics, the equity risk premium. I usually don't pay too much attention to macro forecasts while investing, but there are two macro variables that I keep a close eye on. One is the 10-year US government bond yield, and the other variable is the implied equity risk premium computed by Professor Aswath Damodaran at NYU. After all, even Warren Buffett acknowledges the importance of interest rates in business and investing. And if Mr. Buffett thinks something is important, it usually is. The 10-year bond yield and the equity risk premium together form the opportunity cost of investing in US equities. In other words, this is the return that you can expect to make from an index like the S&P 500 over the long term. Actually, let me slightly modify that statement. That's the return that investors collectively expect to earn from the S&P 500. Whether they actually realize that return is not certain by any means. Before we get into some detailed analysis, I want to first cover off what an equity risk premium is. It is intuitive that investors should demand a premium as compensation for investing in riskier assets. An equity risk premium is basically the return that investors demand over and above the risk-free rate for investing in equities as a class. It is the one number that captures all the emotions of equity investors at any given point in time, all their fears and greed, their hopes and dreams, all in a single number. Let me repeat this. If you want to know how investors are feeling at any point in time, this is the single number that captures it. Even though it might be intuitive as to why we should demand this premium or extra return, you might still wonder whether it is even logical to do so in the first place. If you're happy with, say, a 5% return from a government bond, shouldn't we be equally happy with a 5% return on equities? Well, this chart shows us why. The green bars are the market's expectations of earnings growth for the 500 largest companies in the US over the next 5 years, whereas the blue line represents the actual earnings growth over that period. Now, it should come as no surprise that reality is often more volatile than expectations. After all, equity is a residual claim of the profits of a business as opposed to a contractual claim like debt, and so by definition, it will be more volatile than a contractual claim. You get a lot more of the upside through potential earnings growth, but it also comes with the risk in that these earnings are not guaranteed. This is the reason why investors should, and in fact do, demand a premium for investing in equities. Let's now move on to the types of equity risk premiums. You mainly come across two types of equity risk premiums in the market. One is the historical risk premium, and as the name suggests, it looks at past returns that equity markets have delivered over and above risk-free assets like government bonds. Its estimation requires judgments not only about what type of average to use, arithmetic or geometric, but also about the time frame over which you compare equity market returns relative to returns on risk-free assets. One of its drawbacks is that it is backward-looking, and the standard errors on a historical premium are so large that they render any kind of meaningful statistical analysis useless. The second type of risk premium is the implied equity risk premium. Unlike the historical risk premium, an implied premium is computed in real time, it is dynamic, and it is forward-looking. It incorporates investors' expectations of future cash flows as well as the price they're willing to pay for those expectations today. I won't bore you with the details of how an implied equity risk premium is computed, but suffice to say that it borrows from the concept of yield to maturity on a bond. However, unlike the bond, which has fixed cash flows in the form of coupons on the bond, the cash flows on equities, which are dividends and buybacks, are not fixed, and therefore estimating them requires assumptions around growth. We then discount these future cash flows at a rate that equates the present value of these cash flows to the current level of the index. Let me repeat that. We know the price of the index and we've estimated the cash flows. What we don't know is the rate with which to discount these cash flows to balance the two sides of the equation. We use trial and error to find that discount rate. People who've studied finance will realize that this is exactly like the internal rate of return that we use to analyze projects in corporate finance. When we subtract the risk-free rate from this discount rate, what we're left with is the implied equity risk premium. I have a detailed post on computing implied ERPs, and I'll provide a link to that post in the description to this video for anyone who's interested. Now, what does the level of the ERP tell us about investor psychology? A lower ERP suggests that investors are feeling confident about the future and are therefore willing to take on more risk and pay a higher price for future expectations. This is a euphemistic way of saying that investors are feeling greedy. Similarly, a higher ERP suggests that investors are fearful and uncertain about the future. Hence, they're collectively demanding a higher return from equities than they otherwise would. So with that basic understanding of equity risk premium, Let's get to the more fun stuff and analyze these premiums in a little bit more detail. Professor Damodaran's dataset on implied ERPs goes back to 1961, and since the 2008 crisis, he's been computing this number on a monthly basis. This chart plots the ERP at the end of each year, beginning with 1961. Looking at this chart, there are a few interesting things that we can notice. Firstly, implied equity risk premiums are dynamic and not static. There are times when investors get carried away and demand too low a risk premium for investing in equities, and other times when investors shun equities and demand a much higher premium than warranted. Secondly, ERPs tend to mean revert. They've averaged close to 4.3%, but the range has been quite wide. Notice it reached a low of 2% in 1999 during the famous dot-com bubble, and then reached a high of 6.5% in 1979 on the back of high inflation and the oil shocks of the 1970s, and then again during the GFC during the housing market meltdown. Lastly, another thing that you will notice is that even though the ERP has been mean reverting, there have been prolonged periods when it has deviated from its average. It was consistently below the average for much of the 1960s and has been consistently above it since the GFC. It is only very recently that the ERP has trended down towards its long-term average. One of the benefits of having a rich database that's been created in real time is that we can test its usefulness by running predictive analysis with little hindsight bias. Recall the logic of the ERP. A high ERP suggests that investors are uncertain of the future and are demanding a higher expected return for investing in equities and vice versa. Therefore, implied equity risk premiums should have a positive correlation with future equity returns. That is, a high equity risk premium should lead to high returns in the future. So let's test this hypothesis. First, I'm going to test it over a short time period, say 1 year. I ran a regression with the equity risk premiums as the independent variable and the return on the equity market the following year as the dependent variable. Notice the positive sign with the coefficient of the equity risk premium. This means that next year's return is positively correlated with the ERP. A higher ERP today predicts a high return 1 year from now. This is of course good since this flows from the logic of the implied ERP that we discussed earlier. The t-stat of greater than 2 is also good since it shows that this correlation is statistically significant. However, if you think that ERPs are the magic bullet which will help you predict what the market will do next year, you're in for disappointment. Notice the R squared at just 8%. This means that the implied equity risk premium only explains 8% of the variation in next year's returns, or to put it differently, about 92% of the variation in one-year return on the S&P 500 is explained by factors other than the implied equity risk premium. We can see this with the help of a scatter plot which brings this regression equation to life. This chart plots the implied equity risk premium on the x-axis and the returns on the S&P 500 in the following year on the y-axis. Notice that even though there is a positive correlation between the two variables, it is weak at best. Over longer time periods, however, it is a slightly different story. This time we use the returns on the equity market over the following 5 years instead of 1 year. And here is the regression equation for this. Not only is the correlation statistically significant with the t-stat comfortably above 2, the ERP explains more of the variation in long-term stock market returns, almost 25% in this case. Now we are on to something. This is even clearer in the scatter plot for this regression equation, which is more tightly spread compared to the chart we looked at previously for 1-year equity returns. Now, rather than think about implied ERPs in precise terms, it is also helpful to frame the discussion in terms of probabilities. Have a look at the shaded area where the ERP is less than 3%. Notice that whenever the equity risk premium has fallen below that level, it is almost always followed by poor equity market returns over the next 5 years. Thus, at these levels, the odds of positive return over the next 5 years are greatly diminished. This makes sense because an equity risk premium less than 3% is almost pricing in perfection, and even the slightest hiccup causes markets to correct. Similarly, whenever the equity risk premium has gone above 5%, the market has never had a negative 5-year return, and the odds of success are tilted in favor of the equity investor. Does that mean that the index will never deliver a negative return when the ERP crosses 5%? Of course not. All it tells you is that the odds of that happening are low. Anything within these two extremes is not as clear, with larger drawdowns occurring below the 4% mark than above it, which is what we should expect. There's one final way I want to slice and dice this data. This chart shows the number of years the equity market had a more than negative 10% real return over a 5-year period at various levels of the ERP. For example, The leftmost data point means that when the ERP was close to 2%, in the 5 years that followed, the index had 3 years with more than negative 10% returns. Why did I choose the 10% threshold? It's a bit of an arbitrary choice, to be honest, but a negative 10% year for the market in real terms represents a meaningful correction, and I wanted to exclude years which were only slightly negative. Again, it's not a surprise that difficult years tend to follow when investors collectively demand too low a risk premium for investing in equities. Now, before we get to the conclusion, I want to briefly acknowledge the possibility that equity risk premiums may be structurally higher in a post-GFC world. The difficulty in finance is that all of our data comes from the past, but what we really care about is where we are heading in the future. Normally, the past can be a useful guide of the future, but there are times when a structural shift can make conclusions drawn from past data irrelevant. Therefore, any insights drawn from this analysis should be taken with a grain of salt and shouldn't be upheld as gospel. Remember when we discussed earlier that the average ERP since 1961 has been 4.3% and that ERPs post-GFC have been consistently higher than this average? This is what the ERP chart looks like if we only consider the last 16 years of data, which is post-GFC. It is hard to know whether the higher than average ERPs experienced since the GFC were excessive. One explanation for the high risk premiums post the 2008 crisis is that these reflect a structural shift in developed countries. The events of 2008 woke investors up to economic risks which were previously considered unthinkable in an economy like the US and other developed economies. With the benefit of hindsight, we now know that outside of the big tech, developed countries have struggled for economic growth in the decade post 2008. Hence, be careful when using long-term averages. So where do we stand today? The equity risk premium as of December 2024 is 4.1%. This is not bubble territory yet, which I define as anything approaching an ERP of 3% or less, and we might not get there anytime soon. However, if you were to put a gun to my head, I'd say that the market is probably overvalued at this stage. And the one thing that makes me take a bit of a step back is that this ERP is built on earnings growth expectations reaching close to 10% on an index level over the next few years. If we have an earnings hiccup and the lofty growth expectations don't materialize, this ERP would prove to be woefully inadequate. Of course, we'll know this only in hindsight, and I'm not in the game of predicting the next economic recession. Remember at the end of 2022, when most experts were confident of a pending recession on the back of higher interest rates and high inflation, but what followed was 2 years of a resilient economy, low unemployment in the US, and strong equity market performance. Maybe the economists were just early and not wrong, and we do end up getting a recession after all, but I just don't know this. What I can be more confident of, though, is that after 2 years of greater than 20% returns on the index, finding attractively priced ideas has become harder, and that returns from here are going to be driven by good stock picking rather than a general advance in the market. I hope this video has been somewhat useful. Happy investing everyone, and thanks for watching. I'll catch you in the next one.